Today we're going to talk about a buy and hold trading strategy. Grab some coffee and stick around. Hi, this is Tim from TradingStrategyGuides.com. Welcome back to our channel. Those of you who follow this channel regularly are familiar with my calm cash approach to trading. I typically don't like scalping and day trading. I do it once in a while, but it's more stressful than I like. So I trade on the daily charts, which takes me roughly 4 hours a week, not including the time I spend doing these videos and keeping up with the signals for the Comcash Alerts app. Well, buy and hold is a step beyond my Comcash approach. Let's talk about it. One of the most successful methods of trading is the buy and hold trading strategy. Unfortunately, this has kind of fallen out of favor recently. Still, this strategy is responsible for creating more millionaires than any other trading method in the history of the markets. It worked great in the past, and it works even better today. The buy and hold strategy is a long-term investment approach where the investor makes a recurring purchase of the same stock regularly. You can choose to hold the stock for a few months, years, or even decades. Selecting a stock wisely could allow an investor to gain a regular income and produce an excellent return on their investment. The traditional buy and hold strategy has not performed well recently because traders hold stocks and do not actively manage them when they're not performing well. A modified version has better performance and it's faster. Also, a traditional buy and hold strategy is passive because you wait years and don't make changes to your portfolio, or you trust someone else to make your decisions. We prefer to have an active plan that manages positions regularly. Our strategy is active because we continually monitor all of the stock positions we hold, and we make changes if the company's underlying fundamentals show failing or faltering. In other words, we would change the stock and minimize our losses because we switch to a better company. Before we get into the buy and hold strategy details, I want to share two of the most powerful concepts of why our strategy works. When we understand the why, we can then study the how. I call these concepts the two C's, compounding and consistency. Once you understand these concepts, then you can learn the buy and hold trading strategy. One reason the buy and hold strategy works so well is because of the compounding principle. Compounding is when you make money on your investment, then you roll the profit you just made back into the original investment. For example, let's say I start with $2, then I make $2 on the trade. That's a profit of 100%. Then I take that $2 I made and roll that back into my trade. That's compounding. The process is ongoing, and the gains you make continue to grow faster. But it gets even better than that. The longer you do it, the faster you gain, and eventually you could make millions of dollars. To illustrate compounding even further, I want to ask you a question. Would you rather have $1 million at the end of 30 days or a penny that doubles its worth every day for 30 days? Think about it before answering. I hope you chose the penny because you'd be getting over $10 million at the end of 30 days if you did. Compounding your income over time will do the same, but it takes many years. Here's an illustration of how compounding works to grow your wealth at an accelerated speed. If you're a trader who doesn't have a large sum to invest initially, the best way to grow your account is to add money to your position weekly or monthly consistently. Even if the amount is small, I can't emphasize enough the importance of consistency. I have seen traders with a strong desire to make money with the buy and hold strategy fail because they do not consistently follow the plan. The best example of this situation is the famous story of the tortoise and the hare. The tortoise and the hare planned a race. The hare was so excited to win. He knew that he could win because he's just naturally much faster than the tortoise. He bragged to all his friends about how easy of a win this would be, and then he went home and took a nap. The race started and the hare was nowhere to be found. Meanwhile, the tortoise was on his way to the finish line. It was a long, rocky road, but the turtle never gave up. He just kept going, one step at a time. Eventually, the hare woke up and just thought he would zip to the finish line because of his natural ability. Unfortunately, the tortoise was already there. The hare represents the trader who doesn't want to be consistent, and the tortoise represents a consistent trader. Even a small amount added to your account consistently over time will produce amazing results. Remember, slow and steady wins the race. If you consistently reinvest your profits, the interest compounds at a much faster rate. These are the 2 C's. You will gain income over time. Moreover, you'll be gaining faster each year that you add funds to your position. For example, $10 that doubles to $20 versus $500 that doubles to $1,000. Life gets messy. You need money. You want to buy stuff. Disasters happen, etc. If you're going to have consistency work for you, you must keep investing and you must not take the money out. To illustrate the power of compounding and consistency, take a look at this chart. If you would have bought McDonald's stock at a rate of $100 a week for the last 50 years, you would be holding a total of $13,639,077.03 today. Now that you understand the potential benefits of the buy and hold strategy, we will demonstrate our 3 favorite approaches for you. They are the dividend strategy, the star principle, and the ETF strategy. The first buy and hold strategy we'll discuss is the star principle. Richard Koch talks about this strategy in detail in his excellent book, The Star Principle. I'll link the book in the description below. There are 2 primary components that you should know. Find a new and growing industry to invest in. The reason it should be a new industry is that new industries are known to produce exponential gains. There are many years ahead for rapid growth. For example, when Google started, the growth was exceptional, and if you had invested early on, you would have done exceptionally well. Number 2, find a leader in that field. New industries create a great deal of excitement and growth, and many companies try to take advantage of the opportunity. Typically, one company emerges as the dominant figurehead and far outperforms all the other companies. One recent example of this is Netflix. Netflix is the leader in the new category of streaming movies, and had you invested, you would have made massive returns on that investment. Our investment strategy would be to invest in the best new company in that industry because they have dominated the market and already proven that they can perform well. As time goes on, the stock that you buy regularly will be worth a lot. If you had purchased $10,000 of Netflix in 2005, you would have made $1,788,000 already. There are hundreds of more examples of companies that could have made you rich had you applied the star principle. So what if your trade is losing you money? You can do several things to adjust your strategy and help expand the power of compounding profits. The first thing to do if your stock is not making money is to evaluate the company and ask several questions. Did any of the fundamental data in the company change? For example, did the revenues drop? Is there a new competitor? Were there challenges or obstacles that came up that the company was not aware of when you first invested? Did anything change the future projections of the company? If there are no changes, then you would want to dollar cost average your stock. Dollar cost averaging is when you buy the same stock when the price goes lower to get a better price. Here's how it works. If you buy 1 share of stock for $100 and that same stock goes down to $50, you spend another $100 to buy 2 more shares. Now you have 3 shares and the total cost was $66 per share. If the price goes back up to $100 per share, you've made $34 per share. Dollar cost averaging is a great strategy to help you compound if you still believe in the company. If the stock price goes down and you find yourself losing money, or you find out that the company fundamentals have changed after you evaluate the company, that would be the time to sell. If the company is not as successful as it once was, then it might not be the great company your original research had suggested. Then it would be best if you decided to sell before you lose a sizable amount of your investment and put the funds towards a different star company. Then you can watch your compounding investments continue to grow and add your money to another star business. If you don't move your money, you will be stuck holding a losing stock and you will not realize profits. A dividend is when a company pays you a fixed amount of money to hold stock. A current example of this is ExxonMobil, who pays $3.48 per share. At the time of this writing, the stock's price is $61.35. So if you bought 100 shares, it would cost $6,135. You would get $348 a year for holding that stock, which is about a 5% return on investment per year. How do you find good dividend stocks? We find quality dividend stocks by looking at two different factors. Find a company's stock that increases in value year after year, and choose a stock that increases revenue year after year. You can find these types of stocks by using Yahoo Finance Stock Screener. If you use a dividend calculator, you can see the possible gains that can be made using a dividend buy and hold strategy. If you start with $20,000, in 20 years you will make over $74,000 in dividends alone and enjoy increasing your stocks from $100,000 to $1.3 million. Yes, the dividend buy and hold strategy does produce great wealth. The third strategy is the ETF Buy and Hold Strategy. An ETF, or exchange traded fund, is a fund that holds several stocks. An ETF can have as few as 10 to as many as 500 stocks. An ETF is a basket of stocks. The stocks are put together based on a specific category and are traded as one individual stock. There are ETFs for many different types of classes, including top stocks in a stock exchange, the best gold stocks, the best energy stocks, and the best healthcare stocks. There are many different ETFs to consider. I'll include a link below to a place where you can check them out. The first advantage of the ETF trading strategy is that you get a group of the best stocks in one ETF. Trading with an ETF is helpful because the ETF creator you bought it from already did their research on all the best stocks, so you can take advantage of their research. Each ETF has a complete listing of all the stocks in that ETF. Another advantage is that it reduces the risk of losing all of your investment. If one stock completely fails, you will not lose money because you still have more stocks in that ETF. The primary disadvantage of this strategy is since the ETFs are baskets of stocks, the gains of one individual stock are limited. So just like the risk is tiny, the profits are also reduced. For example, if the ETF is holding Netflix and Netflix increases 2,000%, you will only gain a small percentage of that. One of the problems associated with buy and hold is that it can be hard to buy large stocks if you don't have a large sum of money to start with. Let's say you want to buy a $50 stock, but you don't have $50. You can buy a fraction of that stock for less money and still gain from it. But, of course, it would help if you had a broker that would allow you to do fractional trading. The best part of fractional investing is that you can diversify your account with less money involved. Another advantage is that you can own any stock, no matter how expensive. One of the cons of this strategy, of course, is that you gain less because you only own a stock fraction. Another con of this strategy is that it doesn't work on all brokers. Now you have a complete understanding of the buy and hold trading strategy and why it is one of the most powerful ways to grow your wealth. Our preferred broker for fractional trading is M1 Finance. If you want to try them out, look for the link in the description below. You'll get a $30 bonus for a new M1 account. With M1, you can start with as little as $10 and there are no commissions. The M1 account is explicitly designed for buy and hold trading. That's why we like them so much for our strategies. If you prefer, there are some other brokers that do fractional trading. In addition to M1, there's E-Trade, Robinhood, Vanguard, and Interactive Brokers. Okay guys, that's it for this week's video. Come back for my videos on Monday, Wednesday, and Friday at 3 p.m. New York time. Don't forget to subscribe and hit the bell for notifications. Have a great weekend, and I'll see you with a couple of trade picks on Monday.